Hello guys, welcome to another video from CryptoManager. My name is Linas. I'm the chief engineer for the trading bots and the trading algos risk management. Today we have a video about market neutral strategies, and I will showcase you a strategy which we built and tested in October. I will show you live trades and explain the basic logic behind it. So we plan to implement this strategy for our clients from 2024. I mentioned this last week, and let's start. This will be more an educational video, and yeah, let's start with the basics. So to make so our assumption right now is that the market is bullish, but it is highly unpredictable and it is difficult to expect how much it will crash. So we assume that the market may crash 50% or more. So it will be very volatile, and you cannot guess the top or the bottom and so on. So market neutral strategies play a very crucial role in this, and it is possible to make good profit each month just by being market neutral and anticipating what the market needs. So the basic principles of market neutral strategies are usually this is arbitrage strategies. So you do not take a position and you do not guess the direction. I have this this list of different types of arbitrages and market neutral strategies. So the first one is like special arbitrage, which is like generic arbitrage, where you see the price is different on one exchange, and on one exchange is cheaper, on another is more expensive, and you just quickly buy and sell on both and you have some profit if the fees are not eating on it. Another option is triangular arbitrage, where you have three different trading pairs. We are trading against one asset, for example USDT, and you can trade these assets, and in the end you will have the same result. You are not taking any position or guessing any price direction. You will have more of USDT or more of the asset you were trying to trade. So another is cross-border arbitrage. So this is usually done between exchanges in different regions, where you have banks, they are slowing down the transaction, you have different forex exchange rates, and opportunities arises from that. Another option is statistical arbitrage. So when market prices move, you may find some options where price has deviated from some range. For example, the premium for the futures expiring 30 days later is usually $300 for Bitcoin, and now it's $1,000. So it might be a good statistical arbitrage opportunity to sell and to buy the underlying perpetual futures. So and another is time arbitrage, where you can basically sell and wait, or buy and wait and get the profit from that. Decentralized arbitrage, flash loan arbitrage, futures covering. This is sort of under the same category as time arbitrage. I will talk about I will focus in this video mostly about futures covering and funding arbitrage. So futures covering is basically you have futures expiring at some date, and they have a premium in a bullish market, and in a bearish market they may have a premium, a negative premium. So for example, right now Bitcoin futures expiring at the end of December have about $300 premium. So if you have Bitcoin and you sell futures, you have $300 on top of the current market price. So if you have time, you can wait until the end of December, you can make a profit from that and get an extra $300 per Bitcoin. And funding arbitrage, this one is it can be done between exchanges or inside the same exchange if it has the needed instruments. Basically perpetual futures all have funding. um, they are built by looking at index price from different exchanges. For example, I will show you on Deribit. So yeah, so here you see the index price. This is calculated from Coinbase, Kraken and other exchanges, and the price here is different. It's not the same. So the funding right now is 0.01%. So it is a little bit more than actual price in the markets, in the spot markets. So users have to pay this difference. If you are longing an asset in a bullish market, you have to pay this funding rate. And in bullish markets, people who are shorting the underlying asset are generally receiving the premium, the funding rate. So I will show you in charts a little bit later if it is too complicated for now, but with all the trades I will and examples, it will get likely much easier to understand. So let me check my list. Yes, so we have this Bitcoin Tether chart from Binance. We're not using Binance for this, but I only got the data for funding rates from Binance now. So on October 3rd, funding rate spiked here, and on October 1st, and our indicators were showing that the market will likely explode and the funding rates will change. So we have been anticipating these funding rates to change, and we started building a bot which could profit from that. And from this moment on, you can see here is the line with 0%, and everything on top is positive funding rate, and below is either zero or negative funding rate. So to make everything more clear, for example, we have a long position or short position on BTC perpetual futures in Deribit, and each day we receive funding or we pay funding. So yesterday we received this amount of funding for having a Bitcoin short position for $170,000. This happened because funding on Deribit yesterday was about 0.01%. Yeah, on average maybe a little bit less, 0.0606. So the funding rate was positive. We had a short position equal to $170,000, and we received funding because we were keeping the market, the Deribit futures market, at a balanced way, because more people were longing, so the price was getting higher, so we get paid because we keep a short. So continuing on this strategy we implemented, and we will launch for our clients. So on October 3rd we launched a bot which would long futures expiring at the end of December and short perpetual futures, which would likely have a huge increase in funding, and we would have a market neutral position and at the same time earn funding each day. And likely okay, let me show you. It's difficult to explain without a trade. I will scroll down quickly, and okay, here we launched a bot who helped us accumulate this position. So we currently have a position longing about 5.5 Bitcoin and shorting about 4.6 Bitcoin. Our crypto manager bot is keeping along for this, and this is a different strategy to earn in a market neutral way. Yeah, so to accumulate this position, we launched a bot which started buying futures expiring at 29th of December and shorting BTC perpetual futures. Because when you are trying to enter a position, you don't want to go long 100,000 and expect to be filled at a good price and going short. So this is split it into smaller order amounts, so the risk is not that high, and if we lose and we catch a very big price breakdown, we are not losing a lot, and the bot recovers and the average price is still pretty good. So as you can see, the price we paid was we were buying for 28,680 and we were selling for about 28,320. So about 350 USD premium we had to pay, and we had to buy more expensive because the futures were expiring almost 2 or 3 months in advance. Yeah, so for 3 months we had to pay $300 premium. So, and we started doing that on October 2nd, and we did that a lot. Average premium we paid for buying these futures was about $350 or something like that. So as soon as the market exploded in October, let me show you on the chart. Not exploded, but like the price started going up. Yeah, we started here and the market crashed a little bit in here, and from especially middle of October it started going up properly. So as you can see, the premiums started rising significantly, and the premium for the futures expiring at 29th of December also rose significantly. Now 2 months later we still have the same premium, so we can close our position and we haven't with about the same 320 premium for December expiring futures. And also we have collected for the past 2 months funding. So let me show you the transaction log, and we can have a quick calculation how much funding we have made in the past 2 months. So in total we have collected about 0.092 BTC just in funding. Our starting amount was about 1.13 BTC. I think it was incorrect, it should be 1.2 or something like that, maybe. Yeah, so in general we made 0.09 BTC from a starting capital of about 1.2 BTC without adding too much risk, with being completely market neutral. And for October, I have calculated before, it was 4.3% profit for Bitcoin while it was rising in price. We added 4.3% on top of our capital without any risk of market going down, crashing on us, without any kind of losses from unexpected price movements. The risk in this strategy is that if the price starts moving down very sharply, the premiums may go negative. So you may lose money. It is not risk-free completely, but you are very unlikely to lose money just from a small correction which lasts for 2 days. If the market stays bullish and the sentiment has not changed, you will make money, and you do not care too much about very sharp volatile movements and with drastic price changes, which often happen in a bullish market, and which wipes out most of the retail traders. So yeah, showed you the profits, I showed you the positions, the trades. Yeah, I can show you current premiums as well. So now, as you can see, the average price, the market price here is 36,900, and the December futures are still at $320 premium. So the closer it gets to the end of December, the smaller the premium, and when it is only a few days away or the same day away, the price is almost equal to the perpetual futures price. So by buying futures that are expiring sometime in the future, you pay the premium, and as the time goes, it usually declines. So the premium declines. You are paying something extra to get a fixed price. Why people do that? Because when the market is very bullish and you have funding rates going super crazy, like here, for example, 0.033% per 8 hours is equal to about 4% per month funding. So if you keep along for one Bitcoin, you will pay 0.04 BTC per month just in funding. So it can be pretty painful, especially if you are holding big positions for a long time. So people see, okay, futures premium is only $500, I can afford it, and they just buy this one, and it is how do you say, this is not going to change. So I can plan ahead, okay, this price is okay with me. But if I keep a perpetual futures contract, the funding will change how the market feels about it. If the market is bullish, it may go up. If the market is really bearish, it may go down. So now the market has stabilized. We are planning to close down with futures. If it breaks out a little bit, if the premium goes a little bit higher, if it keeps stale as it is now, we will just close it and take the profits for these 2 months. And yeah, this is the strategy we plan to launch for our clients. I think this is a pretty good one. It is not risk-free, but it is a very good to have in your portfolio, because markets will become super volatile, and these premiums will have moments when they are very high. Also, our strategy for crypto manager clients will involve not just taking 2 positions and getting market neutral. It will also involve just covering futures, because with our indicators we can have like a pretty good statistical prediction how the premiums will change, and maybe sometimes it is better just to short the future and buy the perpetual. So doing this manually is super hard. It is doable, but to do this properly, you probably have to not sleep at all. And doing this in automated way with good risk rules is much better, and in my opinion much safer in many ways. So I will update you on the launch, and this is it for today. We will post a new video next week. Have a great week. Bye bye.